Today, we're going to explore the difference between interest only and principal and interest repayment. When you take out a home loan that requires both principal and interest repayments, you're obliged to pay back the amount that you've borrowed, the principal and the interest that accrues on the sum. The bank determines the interest on your loan using an annual interest rate percentage. They calculate the interest daily based on the outstanding loan balance. Although interest is normally billed monthly, the lender sums up the daily interest amounts for the month. This means that the exact amount of interest charged may vary depending on the number of days in the month. Your principal and interest repayment may be scheduled weekly, fortnightly, or monthly, but each payment will include both interest cost and a part of your outstanding balance, the principal. As you gradually reduce the loan balance, the interest component of your repayment should also decrease, assuming your interest rate remains constant. In the case of an interest-only loan, you are only required to pay the interest part of the loan for a specific period, such as the first 5 years of the loan. Since you're not paying down the principal in this period, the interest charge will remain a constant, and as previously explained, the interest will be calculated on a daily basis but charged monthly. So the interest will remain a constant, providing the interest rate doesn't change. The amount of interest charged each month can vary slightly based on the number of days in each month. After the expiration of the interest-only period, the loan will transition to a principal and an interest repayment. For instance, if you initially obtained a 30-year mortgage with a 5-year interest-only term, the conclusion of the interest-only period would mean that you enter into a 25-year loan term with principal and interest repayments. This transition can result in an increase in your monthly repayments. The key distinction between the two repayment options lies in their outcome regarding home ownership and debt. When you opt for a principal and interest repayment, it enables you to gradually pay off your home loan over time. By constantly making payments that cover both your principal and the accrued interest, you steadily reduce your debt until it's fully repaid. This repayment structure allows you to eventually become the rightful owner of the property, freeing you from the burden of your mortgage. On the other hand, an interest-only repayment approach treats the interest portion of your loan as a rental repayment. While you continue to make interest repayments, you do not make progress towards owning the property or paying off the debt. It's akin to renting the property from the lender, as it only covers the interest costs without reducing the principal. This means that at the end of your interest-only period, you still owe the full amount that you borrowed from the lender. With principal and interest repayments, so long as you continue to make the repayments obliged, you will gradually chip away at the mortgage, ultimately leading you to home ownership. In contrast, an interest-only repayment may provide temporary financial relief, but it doesn't contribute towards building equity or home ownership. When is interest-only a good choice? Interest-only mortgage repayments typically benefit the following situations. Investors, if your goal is to expand your property portfolio, then opting for an interest-only repayment can be beneficial as it provides you with more disposable cash flow. This additional cash flow can subsequently be used to purchase your next investment property, building up either a cash reserve or even using it to invest in stocks or shares. Life events. If you're planning to start a family or build a home, opting for an interest-only term can be advantageous, as it ensures that you pay the minimum amount possible during this period, allowing you to manage the additional costs that come with these life events. The main advantage of an interest-only term is that it lowers your initial repayments. During the interest-only phase, borrowers have lower monthly repayments, which can help reduce monthly living expenses. Tax benefits. Many investors aim to maintain good debt while paying off bad debt. In a scenario where you own both an investment property and a personal residence, most investors will prioritize paying down home loan debt as quickly as possible, while keeping the investment debt intact. This approach allows them to maximize the potential tax benefits associated with their investment debt. Enhanced cash flow. Lowering repayments frees up funds for other expenses or investments, such as home improvements. Flexibility. Choosing an interest-only repayment option does not prevent you from paying off the principal. It simply means that your mandatory payment covers the interest portion only. If you have a home loan product that permits additional repayments, Opting for an interest-only term provides you with the flexibility. You can make either the minimum required, that's the interest-only repayment when necessary, but if you have the financial ability in any given month, you can also pay off the principal amount. This allows you to manage your repayment based on your current financial circumstances, while having the opportunity to reduce your overall debt when feasible to do so. Disadvantages of an interest-only mortgage: increased costs. In general, rates for an interest-only home tend to be higher. Limited equity growth. Unless extra loan repayments are made, home equity will be primarily based on the property's valuation increasing. Repayment shock. After the conclusion of your interest-only period, you'll transition to a principal and interest repayment term and can significantly increase your repayments. Therefore, if you're contemplating a lengthy interest-only period, it's advisable to exercise caution and carefully consider the potential impacts of the subsequent payments post-interest-only term. And if you plan to extend your interest-only period once it ends, most lenders will actually have to complete a full assessment to consider your eligibility. So it's not a guarantee once the interest-only period ends. On the other hand, there are benefits in choosing a principal and interest repayment term. Greater borrowing capacity. Banks assess your loan term based on the remaining principal and interest period. If you select a 30-year mortgage with a 5-year interest-only period, the banks will calculate your repayments based on a 25-year principal and interest loan repayment term. By choosing principal and interest repayments from the beginning, you can increase your borrowing capacity as the banks will evaluate your repayments over a longer 30-year period and thereby increasing your borrowing capacity. Lower interest rates. By and large, lenders offer much lower rates for principal and interest home loans versus an interest-only home loan. Progressive loan reduction. Gradually, on a principal and interest repayment, you will completely pay off your mortgage over time. Faster equity building. By paying down your debt, you simultaneously increase the amount of equity you possess in the property. The choice between an interest-only repayment and a principal interest hinges on how you plan to use your repayment funds and the impact that it has on your ongoing repayments. Though your repayments during the initial interest-only period will be lower, they will rise after your loan converts to a principal and interest repayment term. The matter lies in what you ultimately want to achieve in your home loan repayment strategy. Whether your goal is to pay down your property outright through steady debt reduction or optimize cash flow in the initial years, your choice between a principal and interest-only term will be greatly influenced on your journey towards those goals. Looking for a great mortgage broker? Hunter Galloway is at your service. We operate across Australia and provide our service without a fee. Get in touch with us by our website at huntergalloway.com.au or feel free to give us a call at 1300 088 065. Thanks for watching, and until next time, I'll catch you then.